Welcome to Iron Financial. This is the only explainer you're ever going to need to forge a stronger portfolio and cut right through the market weakness. I'm your lead analyst, and today we are executing a massive, comprehensive structural inspection on a supposed absolute staple of the market, the Coca-Cola Company, ticker symbol KO. They just dropped their Q2 2026 earnings and raised their full-year guidance. But look, here is exactly why we are doing this today. We are sitting in a highly restrictive macro environment. We've got sticky inflation, we've got a tapped-out consumer, and we're dealing with punishingly high interest rates. So the core question we have to answer is simple. Is Coca-Cola actually a durable buy-and-hold fortress, or is this massive earnings report just a shiny facade hiding deep, structural cracks in their consumer foundation? Before we start swinging the sledgehammer, make sure you hit that like button and subscribe so you can keep building a bulletproof portfolio right alongside us.
You said it. I've got my sledgehammer ready, and trust me, I am swinging hard today. Because while the headline numbers might look like solid, reinforced concrete from a distance, I'm here to aggressively test for hollow spots. We're going to stress test the scaffolding of these earnings. I want to dig deep into those non-GAAP adjustments, those questionable price and mix dynamics, and those incredibly convenient currency tailwinds that might just be masking some severe underlying fatigue. Let's see what they're actually building over there in Atlanta.
All right, let's lay out the structural blueprint for today's inspection so we can get right to work. We'll start with the foundation, revenue and growth. Next, the framework, margins and profitability. Then we'll check the global pillars with a regional breakdown, followed by a trip into the vault to look at cash and debt. Finally, we'll deliver our ultimate verdict, fortress or facade.
Keep your hard hat strapped on tight. The heavy machinery comes out right now.
Starting off with the foundation, you simply cannot build a massive, durable enterprise without top-line revenue, and Coca-Cola brought in some incredibly heavy materials this quarter.
Lead analyst. The company poured an absolutely massive $13.38 billion in net operating revenue for the second quarter. That right there translates to a 7% reported growth year over year. But let's strip away the noise. If we look at organic revenue growth, we are looking at a 6% expansion. For those of you forging your first portfolio, listen closely. Organic growth is the purest measure of a company's foundation. It completely strips out the artificial lift you get from currency fluctuations or corporate acquisitions. It proves this is pure, fundamental business expansion. In a highly restrictive, tight economy, achieving 6% organic growth is undeniable evidence of cementing market share. Even better, global unit case volume rose by 5%. Think about what that actually means. Even with global inflation pinching wallets everywhere, the sheer physical volume of non-alcoholic, ready-to-drink beverages they are moving is holding up like reinforced steel.
Okay, hold up, let me stop you right there. I'm pointing my sledgehammer at a massive potential crack in this supposedly rock-solid foundation. If global unit case volume, meaning the actual liquid going into the hands of consumers, grew by 5%, why did concentrate sales only grow by 4%? Why is there a full 1% lag there? Are the bottlers choking on inventory? We have to ask, is the consumer demand actually real, or is this just a total mirage created by supply chain timing and bloated stock just sitting pallets deep in some warehouse? See, that is exactly why we do these inspections. You always have to verify the materials. But I'm going to rigorously defend this foundation using the hard facts right from the filing. The 1% lag you're so aggressively questioning, that is primarily due to the timing of concentrate shipments. It's an accounting reality, not a lack of end consumer demand. The bottlers aren't just sitting on dead inventory. Furthermore, that organic revenue growth was driven not just by the 4% concentrate sales increase, but also by a 2% growth in price/mix.
And boom, there it is, price and mix engineering. So they're just pulling the pricing lever to pave over their underlying volume concerns.
No, not exactly. We need to be incredibly clear on what price/mix actually means. It doesn't just mean, hey, we blindly jacked up the price of a can of Coke. Price/ means consumers are actively choosing to buy products in more profitable package sizes. We're talking about the smaller 8-ounce mini cans that command much higher margins, or they're shifting toward premium product lines. Seeing a 2% positive price/mix growth running right alongside that 5% unit case volume growth proves that this is real, tangible, durable demand. They aren't hiking prices just to hide a shrinking business. They are moving more physical product, and the consumer is willingly paying for it. Let's move the inspection up to the load-bearing beams of the company. We're talking operating margins and bottom-line profitability. Top-line revenue is useless if the framework can't hold the weight of operational costs.
Let's meticulously break down their operating income. Coca-Cola's operating income increased 9% to $4.7 billion. That produced a GAAP operating margin of 34.9%,
which is a very clear, very solid expansion from the 34.1% margin they posted in the prior year quarter. That is an 80 basis point expansion on a GAAP basis. Now, to the untrained eye, 80 basis points might sound like a rounding error, but on a $13.38 billion revenue base, that translates to hundreds of millions of dollars in highly efficient, pure operating income falling straight to the bottom line. The underlying framework here is exhibiting massive structural strength.
Yeah, I'm going to strike that beam hard, because the corporate PR spin on this is totally deafening. They love to tout that 34.9% GAAP margin, but notice how their earnings release desperately directs our attention to this higher 35.6% non-GAAP comparable operating margin. That's up from 34.7% a year ago. I demand to know exactly what financial scaffolding is propping up that higher non-GAAP number. Are they hiding massive restructuring costs in the basement? Are they just casually ignoring stock-based compensation? What exactly is the scaffolding made of?
Look, they aren't hiding a thing. They're isolating the core operations to show you the true run rate of the business. The comparable margin expansion to 35.6% was driven by heavy lifting from organic revenue growth and sharply lower operating expenses. But to your point, there was some serious dead weight dragging on it too. This was not an easy quarter to navigate. They had to fight through the structural drags of significantly higher input costs. We're talking about global inflation hammering the cost of raw materials, sugar, aluminum packaging, transportation, and labor. On top of that, there was a massive surge in marketing spend. Specifically, they poured heavy capital into brand activations around the FIFA World Cup campaign. That kind of global advertising is brutally expensive, yet they still absorbed those massive costs and successfully expanded the margin framework. Let's inspect the mortar holding all of this together. Earnings per share. GAAP diluted EPS grew an impressive 16% to $1.03, but comparable non-GAAP EPS only rose 11% to 97 cents. And here is where I really want to test the concrete. Let's talk about currency impact. The GAAP EPS growth was heavily subsidized by a 4-point currency tailwind, while the non-GAAP had a 2-point tailwind. Let's make this perfectly clear for the audience. When the US dollar weakens against foreign currencies, all those massive international sales translate back into more US dollars, artificially inflating the numbers. If you strip away those favorable foreign exchange rates, is this double-digit growth just a currency illusion, masking a much weaker domestic reality?
It is absolutely not an illusion. It's a feature of operating a highly diversified global empire. Yes, currency swings matter, but even if you completely strip out that 2-point comparable currency tailwind, you are still looking at 9% comparable currency neutral EPS growth. In any market environment, driving 9% earnings growth strictly from operations is a highly durable, fortress-level result.
And speaking of their global empire, let's pivot to inspect the global pillars holding up this entire enterprise. We need to dig into the regional segment performance. I have to praise the reinforced steel we are seeing in North America. This is their most mature market. Typically, mature markets are slow-moving behemoths. Yet, we saw a 3% unit case volume growth paired with a 4% positive price/mix. That dynamic translated into a massive 12% comparable currency-neutral operating income growth. I need you to understand how hard that is. Generating 12% profit growth in a fully saturated market is incredibly difficult. That is pure domestic dominance. Looking abroad, Europe, the Middle East, Africa, and Latin America all showed solid volume growth and positive price/mix, driving value share gains across the board. The pillars are holding strong.
Okay, but do not gloss over the Asia-Pacific pillar. I am zeroing in on a major structural flaw right here on this slide. Look at this anomaly. Unit case volume grew an incredible 8%, supposedly driven by sparkling flavors and trademark Coca-Cola. But the price/mix absolutely collapsed, dragging down a staggering negative 9%. And on top of that, they actually reported value share losses in the total NART-D category in India. I need a rigorous explanation for this. A massive 8% volume jump that gets completely crushed by a 9% pricing drag is a glaring structural red flag. You cannot just pave over value share losses in a massive, critical market like India by pointing to top-line volume. Are they literally giving the product away just to keep the volume numbers pumped up?
That is a fair stress test, but it is not a structural collapse. It is a strategic pricing adjustment. The negative 9% price mix in Asia-Pacific was directly driven by planned affordability initiatives, particularly in India, alongside some unfavorable product mix shifts. They are intentionally keeping price points highly accessible in emerging markets to drive that 8% volume growth. They are cementing long-term brand loyalty today, so they possess the pricing power to raise prices tomorrow. And if you want to talk about offsetting that regional stressor, you have to look at their bottling investment segment. This is where Coca-Cola actually owns the bottling operations in certain emerging markets rather than just franchising them out. That segment showed massive structural strength with a 55% GAAP operating income growth and a jaw-dropping 75% comparable currency neutral growth. The sheer profitability of owning those operations in key regions easily absorbs the temporary margin pressure we're seeing in APEC.
We've checked the foundation, and we've stress-tested the regional pillars. Now, let's enter the vault. We need to examine the raw financial materials, keeping this entire structural framework intact: cash flow generation and balance sheet integrity.
We have to celebrate this heavy-duty cash generation. Let's run the math. For the first 6 months of 2026, Coca-Cola generated $7.5 billion in pure operating cash flow. Once you subtract their required capital expenditures, the money needed to simply maintain the business, that successfully translated into $6.9 billion in free cash flow. Free cash flow is the ultimate lifeblood of any company. It is cold, hard, liquid concrete, ready to be deployed for massive dividends, stock buybacks, or debt reduction.
And this cash generation brilliantly illustrates exactly why management is so confident right now. Let's walk through the upgraded blueprint for the full year 2026. They raised guidance across the board. They now project GAAP net cash provided by operating activities to hit a staggering $14.6 billion. Subtract the projected $2.2 billion in capital expenditures, and we arrive at a projected 2026 free cash flow of roughly $12.4 billion. That completely covers their dividend with miles of safety room to spare, which is exactly what a buy-and-hold investor demands. They are also confidently guiding for a 9% to 10% comparable EPS growth for the full year.
I hear the cash flow numbers, but let me shine a harsh light on the massive elephant in the vault. They are sitting on a staggering $37.0 billion in long-term debt as of July 3, 2026. Yes, they have $12.9 billion in cash and cash equivalents, but that leaves a massive gaping hole. In today's high-rate environment, is $12.9 billion in liquid concrete enough to safely manage that kind of leverage? What happens when they are forced to refinance that debt at today's brutally high interest rates? I am looking at that $37 billion debt load as a massive wrecking ball just waiting to swing into this fortress if consumer demand slips even slightly.
The debt is significant, I won't deny that, but their balance sheet integrity is heavily protected by strategic structural moves. Look at the assets they are actively offloading to become a leaner, capital-light franchise model. They have a pending sale of their African bottling operations. Currently, there are $5.44 billion of assets held for sale on the balance sheet related to this exact divestiture. They actually recorded a reduction in a previously recorded impairment charge by $56 million this half year based on revised estimates for this sale. Offloading these capital-intensive bottling operations is a genius structural move. Once that deal closes, which is expected toward the end of the third quarter or into the fourth quarter, it will dramatically streamline their capital structure, boost their operating margins, and allow them to aggressively deleverage that balance sheet. They are actively managing the load.
Lead analyst, the structural inspection concludes here. We've hit every single load-bearing wall, audited the vault, and rigorously tested the foundation. It is time for Iron Financial to deliver a definitive, no-nonsense verdict on Coca-Cola's Q2 2026 earnings.
I'll summarize my deepest fears for the audience. We have a $37 billion debt load sitting out there like a wrecking ball. We have a 4-point currency tailwind artificially propping up the headline EPS numbers. And most alarmingly, we have a negative 9% price/mix dynamic in the Asia-Pacific region, where volume is soaring but profitability is taking a severe hit due to those affordability initiatives. If the global consumer weakens any further, that debt load is going to feel a whole lot heavier. I am deeply concerned that global inflation, volatile currency swings, and these pricing dynamics are masking some real underlying cracks in consumer demand.
Your concerns are noted, and that is exactly why we stress test. But here is the final, authoritative verdict from Iron Financial. Let's tie it all together. The free cash flow is the concrete. The 5% organic volume growth is the steel. And the 80 basis points of margin expansion is the pure financial engineering keeping it all upright. Despite some minor mortar cracks in regional pricing and the unavoidable weight of a large debt load, the underlying metrics are absolutely undeniable. When you can generate $6.9 billion in free cash flow in just 6 months, expand your GAAP operating margin to 34.9% despite massive global inflation, and drive global unit case growth entirely organically, you are not a facade. Coca-Cola is a structural fortress. It is a highly durable buy-and-hold asset built to withstand broader market weakness.
It's a remarkably strong foundation, I will admit that. But I'm going to leave the audience with a provocative final thought. The company's upgraded guidance explicitly assumes that a 3% currency tailwind will continue to support EPS growth through the end of the year. How will shifting macro pressures and a potentially stronger US dollar impact our next structural stress test? If those currency winds abruptly reverse, will the fortress still hold its ground? That is exactly what we'll be watching for next quarter. Until then, keep forging a stronger portfolio with Iron Financial. Make sure you like and subscribe, and we'll see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.